A no-deal Brexit just got a little less likely. MPs have moved to stop the UK leaving the EU without an agreement, making it much harder for the next Prime Minister to push through a departure by suspending Parliament. Joining us now to discuss is Jagjit Chadha, Director of the National Institute of Economic and Social Research, and Juckes from Soc Gen, still with us as well. Great to have you both here. Jagjit, unless you really want to, I'm not going to ask you necessarily to predict exactly whether a no-deal Brexit is more likely or not, but you've done work about the monetary and fiscal options in the event of a no-deal Brexit. What are they?
Well, they're to try and offset the shock from a no-deal Brexit. We can't really think the probabilities, if we look at the betting markets and the movements in sterling and future interest rate expectations, seem to place the expectation at about a third, the probability of a no-deal Brexit. So let's not play with that too much and take that as a sort of view that's out there in the markets when people are considering whether it's likely to happen. Now, conditional on it happening, monetary and fiscal policy has things that it might want to do to offset the size of the shock. We think the size of the shock to the economy is somewhere between 2 and 3% of GDP. And if we think of that in terms of the shock from the financial crisis, it's about a third of that.
Right.
So it's very similar to the kind of shock that the economy suffered in the early 1990s. Now, of course, you're too young to remember that, but I remember that very well. And I know that was something that monetary policy responded to at that time by cutting interest rates. And there was an increase in deficits for a sustained period on the fiscal side. We think there is room for monetary policy to respond by cutting bank rate, by making it clear that bank rates' duration at a lower level will be maintained for longer, and reigniting asset purchases. Fiscal policy also has considerable room to manoeuvre, and we'd expect deficits to increase for a sustained period to offset, again, the output consequences of a no-deal Brexit.
Kit, are we underpricing the risks of no deal still? And I ask because if you look at cable vol on a 3-month level, it's spiking, but below where it was in March.
Yeah, I think fewer people are doing anything with it. But I think in terms of levels, so for a long time, and I've written lots of times, where do I think sterling would trade against the euro on a no deal or on a deal? And 85 was where I thought when we priced no deal as being really unlikely, and 95, so I thought that's about right. 95, which is incredibly weak in real terms for sterling on a trade-weighted basis, is where I think we would trade, at least we'd trade to that on no deal. So I'm slightly tempted today saying the foreign exchange market, I think, thinks it's 50-50, hasn't got a clue and doesn't know what to do, which is about right for me. And the betting market underprices. If you want to bet on no deal, you make more money. You make more money betting than trading foreign exchange, I suspect. But
Professor, wonderful to have you with us today, particularly with your efforts in quantitative economics. I think of Michael Woodford at Columbia University and the idea, and maybe it can just be a smooth impulse reaction function, where in academics, everything is smooth, everything comes out and dampens out into the future. Is that a no-deal equation, or is a no-deal equation going to be very discontinuous, choppy, and move towards instability?
Look, there are various ways of thinking about no deal. The way of classifying it in policy space is to think of a disorderly or orderly no-deal Brexit. Now, either of those are very hard to envisage. No one's left the European Union before. Certainly, no one envisaged, were we to leave, that we would leave without a deal. So we're trying to understand, the careful modelling of the impact on trade, what might happen. So where you start off in thinking about that are the long-run consequences, because you're able to say to yourself, what happens as we move from one equilibrium or one steady state to another in the very long run? And the analysis is reasonably clear in the economics literature that it means that output in the event of a no-deal Brexit, in which over time the structure of the UK economy diverges from that of the European Union, which is still our major trading partner, is going to have a permanent impact on the level of GDP that would mean it would be 5% lower than it would otherwise be had we decided to stay in the European Union. Having got that long run right, you then need to decide what's going to happen in the very short run.
Right.
Now, you're right to say it's going to be choppy. One of the things that's going to make it less choppy than would otherwise be the case, and that's clear from the stress tests that the Bank of England have done and other organisations, such as the National Institute, is that the financial system going into this potential crisis, economic crisis, has more capital and liquidity at its disposal than it had in the past, which will limit some of those extreme responses that we have seen in the past. And if we add to that prompt and flexible reactions from monetary and fiscal policymakers, which is what we'll be calling for in our review next week, some of this choppiness can be reduced. But you can't control the weather completely.
Okay.
We know that.
Beautifully explained, sir, and I love the mathematics that's involved there or assumed to be there. Overlay the behavioral realities of Thaler of Chicago, Schiller of Yale, or frankly, the good behavioral economics of the United Kingdom. Doesn't the human condition adjust to whatever it's dealt, and we will adjust to a no deal if that's what's dealt?
Well, I think that's basically what I said. We will adjust, but we will adjust, given the structure of the economy that we've got, to a lower level of income than would otherwise be the case.
Understand.
I'm not. No one is saying that it's the end of life as we know it. We're saying that this is a path that we're potentially adopting that's going to mean, over the foreseeable future, us being less well off than we would otherwise be the case. It's not the end. It's a less preferable outcome.